Welcome to Odessal Associates, Accounting and Finance Tutors. In keeping with our series, 9 common accounting mistakes that small businesses make, today we are going to look at one of the most dangerous but common accounting mistakes small businesses make: poor cash flow management. Many businesses don't fail because they are unprofitable. They fail because they run out of cash. Cash flow is the lifeblood of your business. Without it, even the best ideas cannot survive. You are having a profitable business, but you don't have cash to restock, to do other things. Definitely, the business will collapse. It will not last, or you'll be struggling. Now, what is cash flow actually? Cash flow simply refers to how money enters and leaves your business. We have cash inflow and cash outflow. Cash inflow comes from sales, receipts, loan proceeds, investments, customer payments, while cash inflow is salaries, rent, utilities, loan, repayments, purchases, and miscellaneous expenses. So when you have cash inflow, it means that cash is entering into your organization. You are making money either by sales of goods or by rendering services, by renting out things, by getting loans, by getting payment from your investments, gains from investment, by customer paying the money that are owing you. These are ways that money can come into the organization. Then we can also spend money by paying of salaries, the rent of our shop or factory or company, paying utilities like electricities, water bill, and whatever bill that we have to pay, repayment of loans, buying goods for resale, and other expenses. We should know that profit is not cash. You can be profitable on paper and still go bankrupt if cash is not flowing correctly. Remember that in accounting, we have what we call accrual accounting, which means you recognize sales even if cash is not paid, and you recognize expense even if you have not paid. So your profit is not calculated based on the cash you paid or the cash you received, but it's calculated based on the revenue that flows into the organization and the expenses that you make, whether you paid for them or you did not pay for them, whether you received the money or you did not receive the money. So that is why cash is different from profit. You can have huge profit without cash. That is why it is important for us to manage our cash so that while we are making sales, we are able to have enough cash to settle our day-to-day expenses. That's something they call operating capital, which takes care of daily expenses of the business. If your cash management is poor, you won't be able to do this. Now, what are the causes of poor cash flow management? Let's look at some reasons small businesses commonly struggle, not because they are not making profit, but these are the reasons or some of the reasons. One is poor record keeping. Many business owners don't track daily cash movement. Without proper records, you can't know when you will run short or when to expect inflows. So it is right for you to record your sales and record those who are owing you. Record the amount you have. Always ensure that you reconcile your sales with your cash balance, with your receivables, and all the rest. If you have poor record, you will not have idea of when money will come in and when you will pay money. So it's important that you keep a good record. Now, when I say good record now, I'm not actually talking about keeping full accounting record, even though that is important and necessary. But however, if you're able to keep records that will show you the movement of your items in the shop, the record that will show you the amount that you collected and the one you are going to collect, what you're expecting, when your customers will pay, and all those things, it will help you to manage your cash flow. Without this, it becomes difficult. Another one is late or irregular invoicing. For people that trade on credit, customer buys and they did not pay, but you have to put invoice so that they can now pay. Sometimes you can sell goods and then forget to invoice or delay invoicing. So long as the customer have not received the invoice, he feels that he might forget paying or he might delay paying because he doesn't have your invoice. So it is the day you send your invoice that it will start counting. When you did not send your invoice on time, like some company will say, when they have to pay, they will pay 30 days when you have submitted invoice. And if you did not submit, you did the business with the company or the person and you waited for 1 month before you submit invoice, which means it's going to also wait for 30 days before you pay. That's 60 days. This will starve the business of fund, of cash. So irregular or late invoicing can also cause poor cash flow management. Over-reliance on credit sales. If you are selling much on credit, the tendency is that the money will not come in, the cash will not come in as at the time you want the money. Because our people say that it's not the same mouth they used to borrow money that they used to pay the money. So if somebody buys on credit from you, it might take quite a long time. So if you sell heavily on credit, the possibility of cash not coming in when you need that cash will be very, very high. And you know, people that you are buying from might not have the same patience that you have to give you time to pay. They might want you to pay immediately. And if you cannot pay, it becomes a very big problem between you and them. In order for somebody to sue for bankruptcy, the amount of money is just as little as 2,000 naira if you are owing him and you are not able to pay on demand. So in such a situation, you are not able to pay because your customers have not paid you. It becomes a problem and you cannot manage your cash. Another one is excessive spending. You buy more inventory than necessary, overspending on non-essential items, or expanding too quickly. This can drain your cash flow. Yes, it's good to expand your business, but you need to know your capacity. You cannot just because you've seen something, an opportunity that will make you grow, and you don't care whether you are owing people or not. You carry all the money you have and put into that expansion vision or project. Only for you to, after you have paid the money, your creditors are all around you and say, pay us our money. And you are not able to pay. Salary at the end of the month, you cannot pay. Even the current business you are doing, you cannot restock to either to have stock to sell, or if you are producing, to have raw material to use to produce. At that point in time, you see that the investment you made have taken away all the cash you have. At that point, there's a problem. And if you cannot pay, the people that are on your neck can cause a closing down of your business. So you cannot over invest or overspend, especially on unnecessary and non-essential items. When you are doing your business, you need to prioritize and know what items that you invest on. Another is lack of cash flow forecasting. Most small businesses do not plan ahead. Forecasting is to plan ahead. You want to know what you are going to do tomorrow, how much you are going to spend tomorrow, or in a week, or in a month, how much that is coming in within this period. So if you don't plan ahead, it will be a difficult thing. They don't project their monthly inflows and outflows. So emergency catch them unprepared. When you don't project your monthly cash flow, inflow and outflow, when there is an emergency, it will catch you unaware. But if you are prepared, you also prepare for the rainy day in business. It's not only individuals that prepare for the rainy day, even the business person. Somebody might come and say, I want to call up my credit, you should pay me. A bank can decide that, no, we gave you 6 months, but now we want to call back our money. There are reasons and all the rest that bank can give that they need to get their money back. And if you have not properly planned your cash flow, it will become difficult. Sometimes, if you don't have a good cash flow forecast, you might even forget that there is a loan that you pay monthly installment to pay down or to repay. And if it's not there, when the time comes, that's when you remember. And when you remember, there is no cash made available for it because you did not plan for it. So definitely one has to have monthly cash flow forecast. And then you can cut it down to weeks to days so that you will not be caught unprepared at any time. You will be ready and available when there is need for it. Then we also have high operating costs as one of the things that erode our cash. When your operating cost is higher than it should be, your revenue is struggling to catch up with the cost. It becomes a problem, and then you become short of cash. Now let's take an example of a bakery that sells very well. Customer loves the bread. The bread is so sweet, they like it. However, they sell more on credit. Say 60% of their customer buys on credit and they pay after a month. Meanwhile, the bakery has a lot of expenses to make on daily basis. You also need to restock in flour, yeast, pay salaries, buy fuel for generator. But because the customers are not paying regularly, they're paying after a month, and these expenses are calling immediately, there's a problem now because the bakery will not have enough money to do these expenses. So you see that even though he's making a very large sales, even though the business is profitable, but because he does not have cash at hand, it becomes difficult to run the business. The business may look profitable on sales volume, but because cash is tied up in credit, the bakery may struggle to pay salaries, suppliers, and what have you. Let's also take, for instance, a bakery that saw an opportunity in flour. Maybe he used to buy flour 50,000 naira a bag, but he saw where they are giving him flour 40,000 naira a bag. And he has already made a huge difference of 10,000 naira per bag. And the person said, I have 1,000 bags. Okay, let me buy this 1,000 bags. And he carried all the money he has and buy the flour. At the end of the day, he needs to run generator to produce. He needs to buy other things like yeast and other things to add in the bread. He needs to pay a salary. But he has carried all his money to buy this flour. You see that because his money is tied in this flour or the raw material that he bought, he will not have enough money to run his business and make payments to his creditors. So these are problems that can lead to poor cash management. Now, what are the consequences of poor cash flow management? Inability to pay bills, like I've said, loss of credibility. When you cannot pay your suppliers, your workers, and all the rest, every credibility you have will be lost because nobody will trust you to do business with you because they will say, this man doesn't pay, this company doesn't pay. So because of that, they wouldn't want to do business with you, even though they might be sure that you will pay them tomorrow. But nobody wants to wait forever before his money is paid. And you can also miss opportunities because your money might be tied somewhere or because you are not prepared for anything. When an opportunity comes, either a discount or an investment that can yield quick cash, you will not be able to do that because your cash has been tied down somewhere or you don't have enough cash. So if you manage your cash flow efficiently, you'll be able to have money for this. Then this also will lead to increase in borrowing. And when you are borrowing too much, you will pay more interest. And because if you did not manage your cash flow properly, you might be forced to go and borrow money from loan sharks where they will charge you very high interest that will not be convenient for your business and for yourself. So if you increase your borrowing, your interest payment will also increase. And the possibility of default will also be there, which will lead your business to having problem. And the worst of it, it can cause your business to close down. Because when everybody comes at your neck, every day they are knocking on your door to pay another, you cannot pay. The next thing you do is to close down because nobody will even give you stock again. You cannot buy. You cannot pay. Your workers will all resign. They will leave you. So when you are not managing your cash properly, it can lead to serious consequences as high as closing down your business. How do you improve cash flow management? Let's look at some solutions, practical steps by any small business can implement in order to improve this cash flow. One, maintain proper records. Of course, we have identified that when you don't maintain proper accounting record, you have problem in managing your cash flow. If you are able to maintain a proper accounting record, at least if nothing, let every transaction that you did be recorded down and in a place where it will be retrieved and in an understanding format, the format that you can understand such that you can make reasonable decision from it. It must not be 100% accounting style, but the format that you, the small business owner, can understand and will lead you to make proper decision. So you need to do that, record it in that way. However, it's advised that you record it in accounting format, at least the normal bookkeeping, in order to track inflow and outflow. We have all these point of sales accounting software like QuickBooks, Zoho, and others that you can use. Then invoice promptly and follow up. It's not just invoicing. Yes, invoice promptly, that's fine. There are some customers that when you invoice, you don't need to follow up, they will just pay you. But some customers, you need to follow up and ensure that you remind them often so that they will not forget to pay you. So this is one way that you can also manage your cash flow. You should set clear payment terms. Send reminders politely but consistently so that you can get your money paid. Another one is to reduce credit sales. Yes, I know that customers will be pressing to buy on credit. And if you don't give credit, some customers will not buy. You might reduce the quantity you can give on credit if you must sell on credit. Let's assume a customer wants to buy 50,000 naira worth of credit. Say, no, I cannot do 50,000. I can do 25,000. There are some customers that you also profile and say, no, this one I cannot sell on credit because you know that this people will not pay you. Reduce your credit sales. Ensure that you understand your customers very well to know who you can sell on credit and the person will pay as and when due, and who you sell on credit and the person will not pay. Don't give long-term credit. For petty business, 2 days, 3 days, or bigger business, 1 week, 1 month. Maybe if you do supply, 1 month, 2 months. But in that case, the margin will be high because of the time that your money is being tied down. You should monitor your expenses. Cut all unnecessary spending. Review subscriptions. Renegotiate rent. Reduce waste and delay non-essential purchases. So these are ways of cutting your expenses. There are things that does not have business with your business. Leave them alone. Use the money you paid yourself as salary. I told you the other time you can pay yourself salary to do those your personal expense. If not, let it wait till next month when you pay salary and you do them. Cut all unnecessary expenses. Create a cash flow forecast. Prepare monthly or weekly cash flow projection. estimate expected cash in and cash out. This helps you anticipate shortages and plan for them. Build a cash reserve. Set aside a percentage of your revenue monthly as a safety cushion. 5%, 10%, let it be there. This will help you to survive in times of emergency. So it takes discipline to do this. You have to do that. Build a cash reserve out of your sales or your revenue. Remove a percentage and keep aside. Don't invest it. Don't use it. Keep it there on monthly basis in case there is an emergency. Improve inventory management. Don't overstock. Don't also stock less so that you not have stock out. You should have the required inventory. Don't buy too much. Don't buy too little. Buy the one that will help you go on in your business. Look at some of the items you have in your shop. There are some slow moving items. There are some fast moving items. Know how to split the cash you're using to buy between the slow moving item and the fast moving item. Again, like we said in the last video, separate business and personal finances. If this is not done, it will be difficult to have a good cash flow management. You can go to that video and watch what we said about separate business and personal finances. We want to conclude by saying poor cash flow management is one of the biggest silent killers of small businesses. But with proper record keeping, disciplined spending, prompt invoicing, and strategic planning, you can keep your business financially healthy. It's important that you do this so that you will not drag your business into unnecessary risk and ultimately close down your business. This is what we have come up with today. I am sure it will help you if you apply them. Thank you for watching. Subscribe, share, and like. It will help you in your business. And it will also help us in our own production so that we can produce more for you. Thank you. Bye.